In early 2025, a significant trade dispute erupted when the United States imposed a 10% tariff on Chinese imports. In response, China slashed purchases of American goods, triggering economic turmoil for U.S. farmers and businesses. Global markets scrambled to adjust, with Canada and the European Union stepping in to supply essential products China could no longer source from the U.S. China's retaliation extended beyond agriculture to energy, where it strengthened ties with Canada. The newly upgraded Trans Mountain Expansion Pipeline tripled Canada's crude oil export capacity, making Canadian oil an attractive alternative to U.S. supplies. Simultaneously, China ramped up imports of Canadian liquefied natural gas, LNG, leveraging Canada's growing export infrastructure to reduce its reliance on American suppliers. This shift sent shockwaves through the U.S. energy sector. For years, American firms had held prime contracts to supply China with oil and LNG. However, as Beijing diversified its energy sources, U.S. producers saw their market dominance erode. China also expanded partnerships with Russia, Iran, and Venezuela, securing alternative energy supplies at discounted rates. Beyond energy, the U.S. agricultural sector bore the brunt of the trade war. China, once a major buyer of American crops, pivoted toward South America for soybeans, wheat, and corn. Brazil and Argentina became dominant soybean suppliers, while European countries gained ground in wheat and meat exports. American farmers faced mounting surpluses and plummeting prices, particularly affecting small operations unable to pivot to alternative markets. Proposals for government subsidies emerged, but critics argued they were temporary fixes rather than solutions to the long-term erosion of trade relationships. The economic strain extended into political rhetoric when the U.S. president made an offhand remark about annexing Canada as the 51st state. This statement provoked outrage in Canada, with Prime Minister Justin Trudeau firmly rejecting the idea and reinforcing Canada's commitment to sovereignty. The remark fueled a surge of nationalism, leading to boycotts of American goods across Canadian provinces. U.S. products, particularly alcohol, were removed from shelves as a political statement, and organized campaigns urged Canadians to support homegrown industries instead. Meanwhile, Canadian tourism to the U.S. dropped significantly, affecting businesses reliant on Canadian visitors. Destinations such as Florida's beaches and Texas rodeos suffered economic downturns as cross-border travel slowed. Diplomatic engagements between the two countries grew strained, and trust in economic cooperation began to break down. One of the most contentious developments was Canada's proposed 100% tariff on Tesla vehicles. Historically, American cars dominated the Canadian market, but rising political tensions led to discussions of steep tariffs on U.S. automakers. If enacted, the Tesla tariff would make its models prohibitively expensive for Canadian consumers, threatening the company's market share. This move symbolized a broader shift in trade dynamics. Canada explored deeper trade agreements with Europe, expanding automotive imports from German and Swedish manufacturers. The proposed tariff sent alarm bells through the U.S. auto industry, underscoring how escalating trade disputes could disrupt North America's economic landscape. As tensions with the U.S. escalated, Canada aggressively sought new trade partners. Under agreements like the Comprehensive Economic and Trade Agreement, CETA, Canada strengthened ties with Europe, securing deals in aerospace, energy, and high-tech manufacturing. European nations wary of U.S. unpredictability embraced Canada as a stable trading partner. Meanwhile, China capitalized on U.S.-Canada tensions by increasing investment in Canadian energy, mining, and agriculture. The trade war inadvertently strengthened Beijing's influence over North American markets, allowing China to diversify away from American suppliers while ensuring a steady flow of resources. Facing mounting economic losses, Washington debated its next steps. Some policymakers pushed for heavier tariffs on Canadian goods, including a rumored 25% tariff on oil and manufactured products. Others warned that such measures could further isolate the U.S. and accelerate global economic realignment away from American dominance. The trade war also exposed fractures within the U.S. energy sector. Proposals to curb imports of Canadian oil in retaliation against Ottawa's new partnerships faced backlash from U.S. businesses that relied on stable energy prices. Cutting Canadian supply risked increasing domestic fuel costs, hurting American consumers and industries alike. While the U.S. struggled to regain its footing, Canada solidified its position as a key energy and trade partner for Europe and Asia. Investments in renewable energy, mining, and LNG exports allowed Canada to diversify its economy, reducing dependence on U.S. markets. China's strategic alliances with Russia, Iran, and Venezuela further insulated Beijing from the impact of U.S. tariffs, reinforcing its ability to bypass American economic pressure. Europe also began shifting trade away from the U.S., engaging more deeply with Canada for stable supply chains. Some analysts estimated that if Europe redirected just 5 to 10% of its U.S. trade to Canada, it could lead to billions in annual losses for American industries. As trade patterns shifted, U.S. industries faced mounting losses. American farmers, already burdened with unsold stock, saw storage facilities fill to capacity. Meanwhile, manufacturing giants like Google, Intel, and Tesla struggled to navigate restrictions that locked them out of major global markets. Cross-border businesses, once reliant on fluid trade between the U.S. and Canada, also felt the squeeze. Small businesses in border towns saw declining sales as Canadian consumers cut back on shopping trips to the U.S. Some attempted local promotions to entice shoppers, but nationalistic rhetoric on both sides of the border overshadowed grassroots efforts to maintain friendly trade relations. As tensions deepened, the question remained: could the U.S. and Canada mend their fractured relationship? The once strong trade partnership now teetered on the edge of long-term division. The threat of tariffs, retaliatory measures, and shifting alliances had reshaped the economic landscape, leaving both countries at a crossroads. For the U.S., the challenge was to maintain its global influence without alienating key allies. The trade war had inadvertently driven China, Canada, and Europe closer together, forming new networks that bypassed American economic dominance. If Washington failed to recalibrate its approach, the U.S. risked permanently ceding market share to competitors. Canada, on the other hand, found itself in a stronger position than ever before. By securing new trade deals and expanding energy exports, it demonstrated that it could stand independently in global markets. The surge in national pride and economic diversification gave Ottawa leverage in future negotiations, ensuring that any reconciliation with the U.S. would be on Canada's terms. As global supply chains continued to shift, the long-term effects of this trade war would reverberate beyond North America. Would the U.S. find a way to reassert its trade dominance, or had it inadvertently accelerated a new era of economic multipolarity? One thing was clear: 2025 marked a turning point in the balance of global trade power, with Canada emerging as a central player in a rapidly evolving world economy.